Hey, everybody. Welcome to the morning market briefing. Tom's birthday eve, December 6th. Tom, you pumped? Fired up?
I'm just so excited.
We're going to get Natalie in here to sing happy birthday on the call tomorrow. Maybe we could make it happen live.
I've got an early meeting, so I hope you guys enjoy that.
Just tied up. Let's jump in, talk about yesterday's ISM service report. Not great news for the bulls, Ben, as you point out in your notes. The headline accelerated to 56.5 from 54.4, but prices are still pretty elevated. What are your overall takeaways in terms of what we saw kind of on the nuance of the data?
Yeah, I think the biggest thing here is that when we had the ISM manufacturing report last week, I think there was some hope that things were cooling off, and you saw the market rally pretty strongly that day as a result. Prices were down in the 30s. So 50 is the line of demarcation. Above 50 suggests growth. Below 50 suggests deflation or decline. And on the ISM manufacturing report, we were in the 30s, but on the ISM services report, we're at 70. And that only declined from 70.7. So you're going from very, very, very fast to very, very fast. So maybe one less vary, but only down very slightly. Prices still going up. On top of that, employment is returning to growth. That ticked up from 49.1 to 51.5, and production has accelerated. So at the end of the day, on the services side of the economy, things are actually going pretty well. In the construction markets, they say generally unchanged month over month. New business requests are solid, with costs rising steadily for materials, meals, and lodging. On the healthcare side, things are continuing to improve. Retail trade was the only place where they said that inflation was a little lower than last month because supply chain issues are stabilizing. But in general, we're still seeing a lot of pressure on the wage front, and we're also seeing a lot of pressure on just the overall economy and the momentum that it's experiencing. I mean, we have GDP now that's over 3% for the fourth quarter, which would mark another acceleration, which would mark the third acceleration in a row after a weak report in the Q1. We've continued to accelerate throughout the year, and this report suggests no differently, which means the Fed has more to do.
Yeah, Tom, are we seeing reaction in terms of expectations?
Not so much on the short end. We're basically pegged at 2 hikes coming next week on the 14th. But if you look across the curve in terms of where they think rates are going to go, we've definitely seen a noticeable tick up in terms of the February and the May rate hike discussions. So the terminal rate probably moving up. I think that's in line with what we've heard of the Nick Timrouse article saying that he thinks the terminal rate is going to be closer to 5.25. I think that's definitely the read through that we're seeing today. We're seeing not so much in the short term more hikes, but in the long term potentially more hikes across the next couple of months.
Good stuff. We did hear from a couple companies, whether it was on the earnings front or just speaking at conferences. Goldman say that they are not necessarily looking for a recession next year. A little bit of a different comment from JP Morgan. Ben, what are we hearing from the banks?
Yeah, I think that we're definitely starting to see, David Solomon, CEO of Goldman Sachs, is basically talking about what we're seeing in a nutshell. He is saying that he's surprised how resilient the competition for talent is, which basically is a way to say that he's having to pay employees more than he thought he'd have to pay employees at this point in the cycle. He continues to see pressure on the expense line. And he says that while the Goldman economists predict the U.S. will avoid a recession next year, he's actually a bit more cautious on the outlook. So he's saying, from his perspective, he's not really listening to his own economists. He's listening to what he sees. And what he sees is that there's a lot of pressure in the industry right now. Capital markets have not quite rebounded as they had hoped. And clients are extremely cautious, but they're not yet panicked. And he thinks that we could see a little bit more of a decline in the fundamentals going into next year. As it relates to Jamie Dimon, he is a bit more clear. He says that inflation will continue to erode consumer spending power and that a mild to hard recession is likely ahead, which basically is to say a recession is ahead, because mild to hard would imply all types of
Yeah,
recessions.
that's
Yeah.
the spectrum.
Yeah. There
So
will be, I don't know, might be little, might be big.
Yes.
So the Wells Fargo CEO Charlie Scharf says consumer account balances and spending levels are coming down. So what the banks are seeing is they're seeing a lot more cautious outlook than perhaps what we're seeing in the data right now. In the data right now, we're seeing consumers continue to spend, as we saw in the ISM services and report. But inflation is a pernicious beast, and it is really going to hurt consumers, and that's what the bank CEOs are telling us as we go into 2023.
People are spending. Good quarter for Signet jeweler. Tom, I know you've kind of followed this company through the fixed income side, especially for some time, but great quarter, up 6.9% pre-market. Really nice number there. Earnings per share came in at 74 cents. Expectation was for 36 cents. Revenue was strong. They feel like inventory is a good spot. So good quarter for Signet.
Yeah, this is great for us. Signet is, I would venture to guess that it's our most widely held corporate. Most clients have some exposure to this, maybe not some that are a little bit higher on the age scale, because it is considered high yield, but it's one we did a lot of credit legwork on a couple of years ago. Felt really good about it coming out of COVID, and they just continued to impress. So feel really good about those bonds. We bought them when nobody wanted them. They were left for dead, downgraded to junk. We may be one of the top holders there are, because there's only about $147 million in debt that they actually have that's for sale, and I think we probably have somewhere around 5% of that, if I had to guess. So really good for us, good for the boys. That's performed very well despite being a high yield bond. High yield's had a really tough year. These bonds have outperformed the market, so very pleased this morning with that news.
AutoZone also reported comps were up about 6%. Expectation was to be up 3.5%. Revenue came in quite strong. Gross margin quite strong. Seemed to be relatively good execution, although maybe a little bit of a deceleration on the commercial side.
Yeah, I first looked at this report and was fairly pleased. It kind of made sense. People, spending any type of money to make sure that their cars stay on the road. But after I looked into it a little bit more, I was a little bit disappointed with the lack of mobility on gross margin. They only hit 50.1%, which with that sales number, they should have been a little bit higher. And on the deceleration, I'm starting to think a little bit about that a little bit more. And it is a tougher comparison period over the last year, but you don't like to see that. And it's tough to justify the valuation where it is today if you continue to see this deceleration going forward, especially as we have a more softer outlook for 2023. So I would be cautious to read too much into the headline earnings beat on AutoZone because I don't know if it's a great harbinger for the stock going forward.
Good stuff. Intel also issuing a little bit of a warning shot here, a pretty serious warning shot, I would say, on Q1, saying our estimation is that the inventory digestion that's been going on with our customers probably doesn't finish at the end of this year. It continues into next year. That, coupled with macro headwinds and basically every geography out there, didn't give us a ton of confidence that there would be a reason for us to be better than seasonally expected. Not necessarily shocking there, I wouldn't say.
Yeah, I mean, there's a lot of, this is code CFO speak for we're going to miss estimates in Q1 by about 5%. That's exactly what he said. By not saying it, for some reason they'd rather say it that way than actually come out and just tell the market in plain English. But that's what happens in CFO world. And I think this is a little bit of a downgrade from previous Intel expectations. I think that the market was generally there already, but Intel had expected that Q4 would be the trough, and that does not appear to be the case. So I think semiconductors, especially where Intel is concerned, is going to be a little bit tougher going forward. Now, Intel is the wettest of wet paper bags in the semiconductor industry right now. So the fact that they're not doing well shouldn't be a surprise. It doesn't necessarily mean others are doing well, but it does mean that, I mean, if Intel was doing very well and Intel called the bottom, then I would be very confident the rest of the space was doing well.
Yeah.
Intel not performing well doesn't necessarily mean others are performing poorly.
Yeah. And we are seeing some benefits from China reopening. specifically as it relates to Apple, the wait times for the iPhone 14 Pro and Pro Max are down significantly. Wait times now 25 days versus 38 days 2 weeks ago. Where else are we looking to see improvement?
Yeah, I mean, I think that's very impressive. The fact that China is opening up a little bit and we're actually seeing an impact on the iPhone shipping times. I think that's really good news. It maybe helps inflation going down the line, but anything that we can see which eases the supply chain is good. The oil piece to me is going to be a key variable going forward. I was curious about why oil fell yesterday, even with the news about China opening. I think you have this intimation of higher demand as a result of China opening, and yet you saw oil actually reverse lower. So that's something that has drawn my attention, has drawn my attention over the last 48 hours, and I'm going to continue to do some work on that. But that is very curious to me, why oil would be down when China is opening, as evidenced by lower wait times on iPhones.
Yep. We'll continue to monitor that, continue to look for improvement. We'll be back tomorrow morning at 8:30. Hope you guys have a great day, and we will talk to you soon.